So far this semester, we've talked about how you put on your books the purchase of an asset, how you record the purchase of, say, a building. We've also talked about how you record the loss of value the assets have over their life as you use them. So depreciation, how do you take a portion of the cost of your piece of equipment away as you use that equipment over its life. Well, what happens when a company disposes of a plant asset? They get rid of a building, or they get rid of equipment, or they get rid of furniture. How do you take it off your books? Well, they call that the disposition of plant assets. Plant assets are disposed of. A lot of times companies don't use a plant asset for their entire useful life. They will say, yes, this asset has a useful life of 10 years, but after 5 years decide to get rid of it. Why? Well, there's two reasons for it: obsolescence and supersession. Obsolescence means that it's no longer useful. There's just something happened and changed within the industry where that asset that you have is of no use to you. Supersession means while what you have is still useful, it has been superseded by something better that came out. Computers, this happens all the time. Technology is changing all of the time. Companies would buy computers. They would say, we're going to use this computer for 6 years, and then after 3 years, just new computers were so much better that the company thought it'd be better for their overall profitability to get rid of their existing equipment and buy new equipment. And because the state of technology is always changing, the state of real estate in certain areas is always changing, that means that the fair market value of our assets is going to constantly be changing as well, which is a conundrum, because when we put something on the books and we choose a method to depreciate it, we're going to have a certain value that we're placing on our asset on our books, which is a book value that we can't change up and down. GAAP doesn't let you change the book value when something external like obsolescence or supersession happens, which means that our assets book value is barely ever going to match its actual fair market value or the price that we could sell it for. So under GAAP, you can't increase or decrease your assets to their fair market value. You have to wait until you dispose of them, and then you're going to recognize either a gain or a loss on that disposal. So if you're selling the asset at a price that is greater than what your books say it's worth, that's a gain. And it works like a revenue. The difference between gains and revenues is revenues happen from your normal course of business, while gains happen from something that's external to your normal course of business. So if you're a comic book store and you sell some comics, that's sales revenue. If you have a display case in that comic book store and you want to get rid of it to get a better one, well, you're not a furniture selling company, which means that would be a gain. So even though revenues and gains are different things, they work exactly the same, and by that I mean up with a credit, down with a debit. A loss on disposal is when an asset is sold at a price that is less than the book value, and that is going to work like an expense. Again, expenses and losses are different things. One comes from your ordinary business actions, one comes from something that's outside of your typical business actions, but they work the same. And by that I mean up with a debit and down with a credit. Let's take an example right here of discarding plant assets. So throwing out an old asset without receiving anything in exchange, throwing a computer in the dumpster that you no longer want, etc. On December 31st, Mudbug is going to dispose of a piece of equipment. This equipment cost $10,000. It has no residual value, and it's fully depreciated. Well, if it's fully depreciated, and we said it was going to be worthless at the end, and we've depreciated the whole thing, that means our accumulated depreciation on this piece of equipment also has to be $10,000. The T accounts for this piece of equipment and this equipment's accumulated depreciation account would look as such. When we discard these assets, what accounts are going to be affected? Well, we're getting rid of this asset, and we need to take it off our books. We also need to take off our books any other accounts that are tied to this asset. So the two accounts that are being affected are going to be this piece of equipment's accumulated depreciation account and its equipment account itself. What types of accounts are they? They are a contra asset and an asset coming off the books. So our contra asset accumulated depreciation account is going to be going down, as well as our equipment account. Contra assets go down with a debit, assets go down with a credit. So in our journal entry on December 31st, we're going to debit accumulated depreciation for its $10,000, and we are going to credit equipment for its $10,000. Our debits equal our credits. We're good there. when we dispose of equipment. And after we do this, the T accounts for equipment and accumulated depreciation of equipment are both going to have a balance of 0. It's like they're not on our books, and they shouldn't be, because we dispose of this piece of equipment. Instead of having the asset be fully depreciated, let's say that asset has some kind of value and we decide just to throw it out. So on December 31st, Mudbug is going to dispose of a piece of equipment. Equipment cost $10,000, but now it's got accumulated depreciation of $8,500. Well, what do our books look like? There's our T accounts, and when we report this on our balance sheet, we're going to say that the book value of this piece of equipment is equal to its historical cost minus the amount of depreciation on it, $1,500. So we're saying that it's worth $1,500, but we're getting rid of it. And when we get rid of this piece of equipment that's not fully depreciated for nothing, it's going to actually affect 3 accounts. The first one's going to be that accumulated depreciation account, because again, we got to take the asset and all accounts tied to that asset off our books. This piece of equipment is worth $1,500, but we're getting 0 for it because we're just throwing it out. So we're getting less value than our books say it's worth, which means we are taking a loss on this asset's disposal. That's going to be our second account. And then lastly, this piece of equipment has to come off our books as well because we're getting rid of it. They are a contra asset account, an expense account, and an asset account, respectively. The contra asset accumulated depreciation account is going to be going down. Our amount of loss we record from asset disposal during the period is going to be going up, and the value of our equipment on our books, since we're getting rid of this, has to be going down. Therefore, accumulated depreciation of equipment and loss on asset disposal are going to get debited, while equipment is going to get credited. So on December 31st, we start with our accumulated depreciation of equipment account, and as we saw on the last slide, there's accumulated $8,500 worth of depreciation. We need to record our loss on asset disposal. How much is that? Well, it's the difference between what our book said it was worth and what we got for it. Our book said it was worth $1,500. We got nothing, which means we took a $1,500 loss. And the equipment comes off the books for $10,000 when we dispose of this piece of equipment. Say instead of just disposing of the piece of equipment, we actually sell it. So on January 31st, Mudbug Machinery is going to sell a used piece of equipment for $5,000, receiving cash. The equipment originally cost $15,000, and it has accumulated $10,000 worth of depreciation by the time that we're getting rid of it. Well, looking at our T accounts and the numbers reported on our balance sheet, we are saying this piece of equipment is still worth $5,000, which is exactly the amount that we are getting for it. We are selling it at book value. So when we record the journal entry for this, what accounts are going to be affected? Well, we're selling it and we're receiving cash. That has to be one. And then we have to take the asset and all accounts tied to the asset off the books, which means we're going to have our accumulated depreciation of equipment account and our equipment account be affected. What type of accounts? We have an asset, a contra asset, and an asset. Cash, since we're selling it and getting paid for it, is going to be going up, but our accumulated depreciation of equipment account and our equipment account are both going to be going down because they have to come off our books. Well, cash is an asset, it goes up, and it goes up with a debit. Accumulated depreciation is a contra asset. It works the opposite way that assets do, and it's going down, which means it's going to go down with a debit. And then equipment is going down, and all assets go down with a credit. So we know what our debits and our credits are. When we record this entry on January 31st, we're going to debit cash for the $5,000 that we are receiving. We are going to debit accumulated depreciation of equipment for the amount we had on the books, which was $10,000. And we need to take the equipment off of our books, which was on there at a historical cost of $15,000. We sold our equipment for book value. Let's take another example here where we're selling it, but our sale price is not the same as what it's worth on our books. Like I said, it's unusual that your asset is going to be carried on your books for the same price that you could sell it for at its fair market value. On January 31st, Mudbug Machinery is going to sell a piece of equipment for $7,500. This equipment had a historical cost of $12,500 and has accumulated $6,000 worth of depreciation by the time that we've sold it. Well, what do our books say this piece of equipment is worth? It cost $12,500 originally. It's lost $6,000 worth of value, which means our books say it's worth $6,500. But we're selling it for $7,500. We're selling it for more than our books say it's worth, which means we're going to have to record a gain on this asset sale since we're getting more money than our books say this asset is valued at. And we're going to take and fill out this big gigantic journal entry. What's going on here? Well, we're receiving cash in this thing because we're selling it, and cash is an asset and it's going up, so we need to debit cash for the amount of money we're receiving for the sale, which was $7,500. We need to take accumulated depreciation off the books because anytime you sell an asset, you got to take that asset and all accounts tied to that asset off your books. So we're going to debit accumulated depreciation for the amount we have on the books, which was $6,000 at the time that we sell this. We need to take the equipment off the books. Had a historical cost of $12,500. Our debits wouldn't equal our credits at this point. Well, we would know that we need to have another $1,000 on the credit side. Well, what's the $1,000 difference? It's the difference between what our books say this equipment was worth, $6,500, and its sale price, $7,500. So we're going to record a $1,000 gain on asset disposal when we sell our equipment at a gain.